Hello and welcome to Lendy's first investor podcast. My name's Paul Riddell and I look after the marketing for the company. The reason behind the podcast is we've had a lot of questions in over the last few weeks and months about the operation here at Lendy and also about our future strategy. So we've put those questions to three members of the senior management team. Robert, first question of our new podcast. The perception is from some investors that we're struggling at the moment. What's your answer to why anyone should actually invest in the platform?
Well, great first question. The peer-to-peer industry has been going about 10 years. Lendy, about 6 years now. So we're one of the well-established businesses and we consider ourselves a pioneer, a successful pioneer in the industry, but we're learning along the way. This is completely new sector. The banks have been going 300 years. This industry's only been going 10 years. So it's fast paced, we're learning fast, and we've got to think on our feet. And I think Lendy actually have done a very, very good job. £300 million worth of lending, pretty good job. I wouldn't say that's struggling at all. £40 million worth of interest paid back to our investors. That ain't struggling. I would say we could put our hands up and communicate a little bit better about what we actually do. This is not a bank account. They are a higher risk investment and we just need to educate the people on that.
There's a perception that the secondary market has slowed a lot over recent times. It's perhaps dead. Does Lendy understand that the secondary market is perhaps proxy for confidence levels, and what can be done to turn this around?
We certainly appreciate that our secondary market has slowed down. We're one of the few people actually that do have a secondary market in the peer-to-peer lending. And like all secondary markets, it is susceptible to supply and demand. We are doing a number of things, and we have done a number of things, cashbacks, bonuses. We are even considering the discounting model, and you need to watch this space at this stage. We put a lot of money behind recoveries and collections, so we can try and stimulate a little bit more flow and growth into that area, so you get your money back quicker to reinvest in some of these opportunities. But really all I can say is watch this space. We are aware of it, we are trying our best to stimulate it.
Is there an easy way to find out why investors do not receive their full interest payments against the figure that they've invested?
Yeah, I think the question you're answering is if a loan goes past its maturity, I can't see how much interest I'm accruing. And I agree that needs to be there. I don't think it's there at the moment. I'm a few weeks into the job. I have pulled that up with our IT guys. It is on the IT list. Watch this space.
Has Lendy considered buying a collateral UK loan book? There's just been some rumours in the market.
In a short answer, no. We have considered it. We had a little nosy around, and we're a nimble business. We're always open to opportunities and acquisitions that fit our business strategy. In this instance, it's a no. Some
investors have asked if there is an easier way for them to tell whether a loan party is attracting interest or whether it's not.
Yeah, currently we don't actually support that feature, but I agree with our investors. We need that. I have put that on the flight plan for the IT team.
We get this question a lot. Why do we not pay interest when an investor puts a loan part up for sale on the secondary market? Yeah,
it's part of the business model. We have to offset these kind of things with the considerable costs we do when recovery, when a loan goes out of tolerance. So it's part of the business model. It's also worth noting, unlike other people, we don't actually charge a fee to post your loan part for sale on our secondary market.
For investors who have a lot invested on the platform, can you explain what you're doing to protect their capital?
Of course. As we know, all investments carry risk, but we believe we take all reasonable steps to protect your capital. We only ever have LTVs of 70% or less. We do active due diligence on borrowers. We use top drawer legal firms, and we only use RICS-registered valuers to make sure the valuations are of a quality that you as investors would expect.
We've had a lot of questions in on this one, but do you have plans to launch an ISA?
So we are considering launching an IFISA. There's been lots of consumer feedback for this product. As you may or may not be aware, we do require full FCA approval to launch an ISA, and we're working with the FCA to get that approval. As and when we have an update, we'll share that with you.
Okay, how does Lendy justify there is future claims in its provision fund? The provision fund should have clear and settled asset, otherwise how can it be used to cover claims?
That's a good question, Paul. Thanks for asking. The provision fund's actually formed of two components. There is a cash balance held in a separate bank account with a separate legal entity, and that's derived from upfront fees with the borrower, and that's increased with each new loan as it's drawn down. And secondly, we have a future contracted income, which is additional interest that we charge to borrowers who go into default. And again, because that's a set number, we can project that, and those two numbers together form the provision fund, and the protection around it, and all the figures that you need to know are all listed on our website and updated monthly.
You say you are very keen to make the platform as transparent as possible. We've had one suggestion in about publishing monthly statements from our receiving bank to show which borrower paid what amount, so they can see that we're not hiding important information from our lenders. What's your answer to that?
So unfortunately we can't share this level of borrower or indeed investor information at that level of detail because it breaches privacy and data protection regulations on multiple levels. However, we are looking at ways to make the platform more transparent and more democratic, and as those features come online, we'll share those with you.
We've had a large number of questions in on this one, Paul, and you probably won't be surprised, but when will Lendy receive FCA authorisation?
So it's a good question that I get asked fairly regularly, so I'm happy to take it, Paul. Thanks for asking. So it isn't unusual that FCA approvals take a period of time. In fact, a fellow peer-to-peer lender was approved after 27 months, and that's longer than the Lendy FCA approval has been in progress. As I say, it does take time. We are one of the later P2Ps to get their approval, but we're working closely with the FCA, and as and when we achieve approval, we'll share that with you.
When will Lendy be improving its support model, its customer services model?
Okay, thank you, Paul. So as you may be aware, we've always operated a low cost model, and that means we can maintain double-digit returns for our investors. To do that, we need to keep our operating costs low, and of course that includes the cost of servicing queries and questions that come from investors. We're mindful that as we've grown, there's been pressure in this area, so in response to that pressure, we've hired a head of customer service to head up a completely new function for Lendy. We've also made 4,500 outbound customer service calls to get feedback, although we should be mindful that this is an online platform, it's a self-service model, and to enable us to sustain those high returns for investors, we need to maintain that low cost base.
We've had a few questions in on this one, James, which won't surprise you. Yeah. But why is such a large part of the loan book currently non-performing and overdue?
You're absolutely right. We have had historically issues with a lot of the older loans, but we are working as hard as we possibly can to resolve those issues and to recover the outstanding sums owed to our investors. I think one of the things that we have to, and we are trying to get across to our investors, is the reason why we're able to offer the rates that we do is because of the nature of the borrowers and the nature of the properties, which means that the enforcement of these loans and the recovery are not as easy or as common as they might otherwise be.
A follow-up question, James, on overdue loans, because they are causing some of our investors some concern, particularly those who believe they're not receiving any interest at the moment as well. What can you say to reassure them that you're on top of some of these more tricky loans?
Okay. I 100% understand that the current level of the non-performing loan book is of a concern to investors. As I mentioned earlier, we're doing all that we can to try and resolve those. All I can say is that this isn't a Lendy-specific issue in the marketplace in general. Non-performing loans are increasing. It's not even a P2P sector, and high street lenders are facing the same issues. Just turning to the point you made about the interest, in order to give our investors hopefully some level of comfort, When we are successful, and we have been successful in the past in recovering the outstanding sums, the interest continues to accrue even after a loan's due date. So when we are successful in recovering those, then that will be payable to investors. And certainly on the overdue and non-performing loans, we're doing all we can to recover those sums on top of the capital that's outstanding.
We've had quite a lot of questions in about Sunbeam and suggestions that it looks like you might have taken your eye off the ball. What's your response to that?
Okay. I understand the frustration from our investors on this particular matter. We were in constant contact with the borrower, the broker, for significant periods of time before the loan became due. The broker in particular is known and trusted, and we continue to work with them, so we had no reason to doubt the information that we were being provided with. And we held face-to-face meetings with both the borrower and the broker very, very close to the due date. At no point during that process were we aware that this loan wasn't going to be repaid on time. Having said that, as I said earlier, I understand the frustrations, and certainly there are lessons to have been learned by Lendy on this particular matter, which we will take on board and ensure that these types of issues don't occur in the future.
We've had a few questions in just on GDV and the suggestion that using it as security value is unjustified, especially for, say, stressed loans. How does Lendy justify using GDV for loan-to-value calculations?
Okay. The starting point, as our investors know, is the combined land value, the acquisition value of the land, and the development build cost will never exceed 70% of the GDV. So we have that 30% buffer there already on day one. The second point, I think, to add is that we aren't lending the development loan in one single tranche on day one. It is only provided to our borrowers once we have certification from independent monitoring surveyors that works have been done. I think those two things combined are able to assist and protect our investors from any issues.
How would Lendy handle recent loan tranches that are currently impossible to fill? The Suffolk House loan, which is PBL 199, for example, at current funding speed probably won't be funded even until loan expiration and not even draw down. So what's your answer to that?
I think what we are trying to do in situations like this is we're always trying to offer our investors incentives in order to invest in these particular loans, and we are providing offers such as cash back in order to encourage them to put their investment into that particular vehicle. I think in the event that those aren't successful, we will always, as a backstop, try to negotiate with the borrower to make the investment opportunity a lot more attractive to our investors by potentially adding other security or other monies that they may held into the pot in order to reduce LTV and therefore the risk to our investors. Just turning them on the development and the tranches, obviously there have been occasions where recently they haven't filled as easily as in the past, and I think in those circumstances what we will tend to do is cut at the level we have been able to fill and then relaunch the balance of any tranche that needs to be filled.
With the economic uncertainties ahead, how optimistic are you about Lendy and the future of the sector?
Lendy is one of the most established players in the sector, and I think it's extremely well placed to tackle any opportunities a post-Brexit Britain may generate. I'm a new member of the newest member actually of the senior management team, and what attracted me to Lendy was its potential to be a real flag bearer in this sector and generate a huge amount for the UK economy. Lendy has attracted some huge hitters to its senior management team, from the likes of Royal Bank of Scotland, AXA, Santander, HSBC. And together we've got some fabulous ideas to move this business forward. And you, the clients, are going to be part of it. And together we're going to fuse new technology and solve some of the old traditional banking problems we've got. It's exciting. Watch this space. Hold on to your hats.